In 1680, a merchant house in Japan did something that would look painfully boring to you today. No secret treasure map, no genius stock picks, no high-risk gamble. They opened a ledger, wrote down every coin that came in, every coin that went out, and they treated not wasting like a moral duty, not a cute lifestyle trend. Meanwhile, samurai on fixed rice stipends were quietly going broke because they lived like their status was an income source. The merchants weren't richer. They just had a system that made it harder to be stupid. And I'm teasing that on purpose because the most dangerous lie in American money culture is that your problem is intelligence. It's not. It's environment. It's defaults. It's friction. It's the invisible machine around you that turns impulse into monthly payments. My name is Tom, and I spend way too much time thinking about money behavior, debt mechanics, index math, fees, inflation, and the psychology of why disciplined people still end up broke. If you're someone who makes decent money, works hard, tries to be responsible, and still feels like you're running on a treadmill that speeds up every year, subscribe and like this video. It'll help more than you think. By the end of this video, you'll understand the exact mechanism that quietly drains your buying power while making banks, card networks, and helpful finance apps richer. And you'll see how an entire country built everyday habits that fight that mechanism without needing willpower. I'm going to show you the exact pattern that the modern money system uses to profit from your convenience, and the simple Japanese habits that flip that pattern so the convenience works for you instead of against you. And to explain it, I need to take you from that boring old ledger to a moment when Japan itself learned the hard way what happens when easy money feels normal. Because look, Japan didn't become disciplined because everyone there is magically wiser. Japan got traumatized by a financial story that Americans keep reenacting in smaller ways every single month. Here's the thing. Nobody tells you. Japanese money habits isn't about being cheap. It's about designing your life so you don't need to negotiate with yourself every day. Americans treat money like a moral test. The Japanese approach, when it's done well, treats money like engineering. So let's strip the fantasy away. When most Americans hear Japanese money habits, they imagine tiny apartments, walking everywhere, never buying anything fun, eating instant noodles, and somehow becoming wealthy through suffering. No, that's not the habit. That's the stereotype. The real habit is this. Japan has a culture of separating money into purposes and protecting the future category like it's sacred, not because they're saints, because the system rewards consistency and punishes chaos. Now, you might be thinking, okay, Tom, but Americans already know budgeting. We've heard it 10,000 times. I agree. And most budgeting advice is useless because it assumes you will behave like a calm robot. You won't. I won't either. Nobody does. So I'm not going to tell you to track every latte. That's amateur hour. What I am going to show you is how to build a personal money system that makes your biggest financial win happen automatically while your everyday spending stays human. Let's start with a shocking reality check. A lot of Americans are walking around with credit card interest rates north of 20%, like that's normal. Because it is normal now. And that means if you carry a balance, your money has to earn more than 20% just to break even. Read that again in plain English. The moment you carry revolving debt, you're not investing. You're trying to outrun a treadmill set to sprinting speed. And yet people will brag about getting 2% cash back like it's a strategy. Let me make it concrete. Imagine you spend $2,000 a month on a card that gives you 2% back. That's about $40 back each month. Nice. Feels like winning. But if you're carrying a $5,000 balance at, say, 24% interest, that balance costs about $100 a month in interest, give or take, depending on how the issuer compounds it. So your reward is $40, while the same system charges you roughly $100 for the privilege of not feeling pain when you pay. That's not a rewards program. That's a distraction program. This is where it gets really interesting. Japanese money habits are, in a sneaky way, anti-distraction habits. They are designed to keep you from getting hypnotized by the wrong scoreboard. In the United States, the scoreboard is lifestyle. Bigger car, nicer house, better vacations, better gadgets, better everything. And it's financed, it's smoothed, it's made painless, which means it's made invisible. In Japan, the scoreboard is stability, predictability, not being a burden, not getting trapped. That doesn't mean no fun. It means the first priority is not getting cornered. And if you're an ambitious guy watching this in the United States, you should copy that part, not the surface level stuff, the structure underneath it. Because when you're building toward $1 million, the biggest enemy isn't missing the next hot investment. The biggest enemy is leaking momentum. Momentum leaks through three main holes. 1, high interest consumer debt. 2, lifestyle inflation that quietly eats raises. 3, chaotic money flow where nothing is protected and everything is negotiable. Japanese habits plug those holes with boring rules, and boring rules beat heroic motivation every time. Now you're asking yourself, okay, what are those habits exactly? And how do they apply to me in America? Let's walk through the core ones, but we're gonna do it like an engineer, not like a motivational speaker. Habit 1, separation by purpose, not by category. Americans budget by category. Rent, groceries, gas, entertainment, that's fine, but it misses the real battle. The real battle is not how much did I spend on groceries? The battle is, did my future get paid first or did my present eat everything? A strong Japanese-inspired system separates money into purpose buckets before you have a chance to interpret it emotionally. And yes, Japan has a famous home budgeting tradition often described as a household ledger approach. But don't get hung up on the cute notebooks. The notebook isn't the power. The power is the rule. You decide the future allocation first, then you live inside what remains. That's the inversion that most Americans never do. Most Americans do. Live life first, then see what's left for investing. Japanese discipline, at its best, does. Secure the future first, then live life without guilt inside constraints. And the psychological shift is massive because when you invest what's left, you feel deprived. When you invest first, you feel protected. Habit 2, building friction against impulse on purpose. In America, everything is designed to remove friction. One-click checkout, tap to pay, buy now, pay later, auto-renew subscriptions, stored cards in your phone, suggested tip screens that guilt you into paying extra for a coffee. Convenience is not neutral. Convenience is a revenue strategy. Japan, culturally, has more friction in everyday spending in a way that nudges restraint. Not always, not perfectly, but enough to matter. Here's the thing. Friction is not about punishment. It's about time. Impulse is fast. Wisdom is slow. So you need a system that inserts time between I want and I bought. Now you might be thinking, Tom, I don't want to live like a monk. I like nice things. Good. Keep liking nice things. I like nice things too, but make nice things compete against your future in a fair fight. Because right now, your future doesn't even get a seat at the table. Your present swipes the card and your future gets the bill. Habit 3, treating debt like a weapon that can cut both ways. Americans have been trained to treat debt like a normal subscription to adulthood. Car payment, credit card, student loan, mortgage, and then, because the payment is affordable, it doesn't feel like danger. Japan has a stronger cultural allergy to consumer debt, historically speaking. And you can argue about the reasons, but the effect is what matters. Less casual acceptance of high-interest revolving debt as a lifestyle tool. And for you, specifically, the key is not never borrow. The key is never borrow at a rate that turns your life into a treadmill. A mortgage at a reasonable rate on a house you can afford is a different animal than carrying revolving credit at 20% plus while telling yourself you'll invest later. Because later becomes never when your cash flow is handcuffed. Habit 4, prioritizing longevity of purchases, not just price. This one sounds basic, but it's not buy cheap versus buy expensive. It's buy fewer decision points. In Japan, there's a stronger appreciation for maintaining things, repairing, using items longer, and buying with the idea that the purchase should disappear from your brain for years. Americans buy things that create recurring decision fatigue. Upgrades, replacements, accessories, subscriptions, add-ons. Decision fatigue is expensive, not because the thing costs money once, because it keeps re-entering your attention and demanding more spending. A purchase that you never think about again is often cheaper than a purchase that keeps dragging you back into the store. Habit 5. Using windfalls as structural upgrades, not lifestyle spikes. Japan has a bonus culture in many workplaces where a chunk of compensation arrives in big periodic payments. That creates a psychological pattern. Windfalls are not free money, they're system money. I want to really act. Americans get windfalls too. Tax refunds, bonuses, commissions, RSU vesting, side hustle months, even a few good trading weeks. And most people treat those as permission slips to splurge. Japanese-style discipline treats windfalls as a chance to reinforce the structure. Pay off toxic debt, build reserves, invest, fix a real bottleneck in life, not celebrate with a new monthly payment. Because here's the dirty secret. The fastest way to kill your wealth building is to convert temporary income into permanent obligations. Now, all of that sounds sensible, but I haven't shown you the deeper pattern yet. The deeper pattern is what happens when a whole society gets seduced by easy money and then spends decades paying for it. So let me tell you about Japan back in the late 80s. Picture Tokyo, neon everywhere, luxury brands exploding, real estate deals being whispered over drinks, like they were classified information. Companies buying assets not because they needed them, but because prices were rising and nobody wanted to look stupid. And here's a vivid detail people forget. There was a period where golf club memberships in Japan were traded like investments. Not because golf is suddenly more fun, because people believed everything scarce would go up forever. Now, why would they do this? Because the cost of money felt low, credit felt available, and the social proof was overwhelming. When everyone around you is getting rich, you start feeling poor for being cautious. But here's the catch. When caution feels like missing out, you stop measuring risk. You start measuring envy. Step 1. Banks and lenders get aggressive. They lend against assets whose prices are rising, which makes the rising prices look safe, which encourages more lending. Step 2. Companies and households borrow more because debt feels manageable when your assets keep inflating. If your property value goes up on paper, you feel richer, so you borrow against it, so you spend more, so the economy looks strong, so everyone gets more confident. Step 3. Speculation becomes normal life. People who would normally be conservative start thinking of assets like a slot machine that only pays out. The mindset shifts from, can I afford this, to how much can I leverage? Now, you might be thinking, okay, but what does this have to do with me? I'm not buying Tokyo real estate. Hold that thought. Step 4. The system becomes fragile because it depends on one assumption. Prices keep rising. The moment prices stop rising, the entire story changes. And that moment came in the year 1989. Japan's stock market hit a peak that felt like a national victory lap. And then it started falling. Not a cute little dip. A long, brutal decline that turned confidence into denial and denial into panic. This is where it gets really interesting. The pain wasn't just that prices fell. The pain was that people's identity was built on the assumption that they were winning. When the Nikkei fell dramatically from its peak over the following years, that wasn't just numbers on a screen. That was retirement dreams, corporate balance sheets, and household psychology cracking. But here's the catch. The worst damage came from debt. Because when you buy assets with borrowed money, a price drop isn't just a paper loss. It becomes a cash flow crisis. Now you're asking yourself, so who got destroyed? Regular households who stretched. Small businesses who borrowed to expand because the economy is booming. Workers whose companies were living on inflated balance sheets. Anyone who assumed the boom was permanent and who survived better. The people who had reserves, the people who weren't dependent on constant asset inflation to feel okay. The people who treated debt like fire, not like warm lighting. Here's another interruption. Do you know what a crash does to human behavior? It doesn't just reduce spending, it rewires trust. After the bubble, Japan went through long periods where growth felt sluggish, wages felt stuck, and safe became a cultural obsession. And yes, there are macroeconomic debates about why Japan experienced what it experienced. But I'm not doing an economics lecture here. I'm talking about household behavior and the lessons burned into a society. One of those lessons was, don't let your life depend on an asset price staying high. Another was, don't build your normal lifestyle on borrowed money. Another was, stability is a form of wealth. Now, crisis point. Imagine waking up and realizing the thing you thought was your safety net is now your trap. Property values down, stocks down, businesses cutting back, and your debt payment is still the same. That's what a debt spiral feels like. The world gets tighter, but your obligations stay wide. People became desperate. Companies became cautious. Banks became reluctant. And the psychological scar was deep. A generation learned that paper wealth can vanish, but bills do not vanish. Aftermath is always the most revealing. Who won? The institutions that could absorb pain, restructure, and keep collecting. Who lost? The people whose plans assumed the good times were normal. And here's the kicker. Once fear sets in, households often overcorrect. They hoard cash. They avoid investing. They choose safety even when safety quietly costs them. So what does this have to do with copying Japanese money habits? Everything. Because modern Japanese household habits make more sense when you see them as scar tissue. The West often mocks Japan as too conservative. But Japan learned, brutally, what happens when the system sells you a story and you build your life inside it. Now take that pattern and look at America today. In America, the bubble isn't always a national real estate mania. Sometimes it's personal finance mania. It's the idea that you can finance a lifestyle and out-invest the interest. It's the idea that your salary will always rise fast enough to cover new monthly payments. It's the idea that convenience is harmless. Just like the Japanese bubble era normalized leverage, modern America normalizes consumer leverage. And the villains aren't cartoon characters twirling mustaches. The villains are incentives. Banks profit when you carry balances. Card networks profit when you swipe more. Retailers profit when you buy faster. Ad platforms profit when you feel inadequate and click. Buy now, pay later. Profits when you turn wants into debt. And you know who the victim is? The guy who thinks he's being responsible because he's earning points. Now you might be thinking, so what's the Japanese answer, Tom? Just never use credit cards? No, that's too simplistic. The Japanese answer is structure, separation, friction, reserve building, and a respect for cash flow that Americans lost. Let me give you an everyday analogy so simple it's almost insulting. Imagine you buy a car for $30,000. You put down $5,000. You finance the remaining $25,000. The payment feels manageable, so you feel fine. For a while, the car feels like freedom. You're driving, life is good. You feel like an adult. You barely notice the payment because it auto-drafts. You feel nothing. But then, a year later, you get offered an upgrade. New model, better screen, better features. The dealer says, don't worry, we can keep your payment almost the same. You feel excited. You say yes. Now, 2 years later, you're paying the same monthly amount, but you extended the timeline. You owe more for longer. The car is worth less than the debt early on because depreciation is fast. Then something happens. You get a job change, a medical expense, a family situation. Nothing dramatic, just real life. Now you need flexibility. But you don't have it because your monthly obligations are locked in. The car is worth maybe $18,000. You owe maybe $22,000. You're underwater. And you're not underwater because you're stupid. You're underwater because the system made it feel painless to say yes. That's the trap. Painless yeses create painful futures. Now translate that exact feeling to money habits. The American system is built to make spending painless. Japanese habits are built to make overspending slightly annoying. Annoying is good. Annoying is the sound of your future trying to speak. Now, let's connect the analogy to the main topic. When you remove friction from spending, you buy more than you think, more often than you remember, at terms you barely notice, and you wake up with a life that is fine but not free. And freedom is the only thing that makes investing powerful. Because investing is not just math. It's optionality. This is where it gets really interesting. The gap between the guy who hits $1 million and the guy who doesn't is often not income. It's not IQ. It's not working harder. It's whether he built a system that protects surplus. Surplus is what becomes wealth. And surplus does not survive in a frictionless spending environment unless you engineer it. Now let's talk math, because I promised you math. If you invest $1,000 a month for 30 years and you earn around 7% annually, you end up with about $1.2 million. If, instead, your real return becomes closer to 6% because of fees, bad timing, panic selling, and cash drag, you end up with about $1 million. That 1% difference doesn't sound dramatic. It sounds like nerd stuff, but it's about $215,000 over that timeline. $215,000 is not small. That's years of freedom. That's the ability to say no. That's not having your identity tied to a paycheck. And most people don't lose that $215,000 because they picked the wrong index fund. They lose it because their behavior creates a hidden fee. Impulse spending is a fee. Lifestyle inflation is a fee. Carrying high interest debt is a fee. Constant upgrades are a fee. Panic selling is a fee. Japanese habits are basically a behavior fee reduction strategy. Now, another math example that hurts. If you leak $150 a month in subscription creep, random upgrades, delivery fees, and its only purchases, and you invested that $150 a month for 30 years at around 7%, you end up with roughly $180,000. $180,000 from money you barely remember spending. That's not coffee. That's not avocado toast. That's death by invisible paper cuts. Now, you might be thinking, Tom, come on. I want a real strategy, not cancel Netflix. I get it. So let's go deeper. The point is not canceling one subscription. The point is building a money firewall. Japanese households, at their best, don't let every dollar be available for every purpose. They separate, they label, they protect. In America, money sits in one checking account like an open buffet, and your phone is a slot machine that pulls from it. So here's the antagonist reveal, because this is the part people need to hear without sugarcoating. The modern financial system is not primarily built to help you build wealth. It's built to monetize your behavior. And the biggest villain is not one company. It's the combination of banks, card networks, lenders, retailers, and ad platforms that all profit from the same thing: you spending faster than you build surplus. Who benefits from this pattern? Everyone who earns a percentage when you swipe, plus everyone who earns interest when you carry a balance, plus everyone who earns when you subscribe and forget. Why do they do it? Because predictable monthly cash flows are gold. Your monthly payment is their stable revenue. And you know what's even better than you paying in full? You paying over time with interest. This is why the system constantly sells affordable monthly payments instead of total cost. Now, how do they hide it? 3 tactics. And once you see them, you can't unsee them. Tactic 1, they gamify spending with rewards. They make you feel like a disciplined investor because you got points. They turn consumption into a scoreboard so you chase dopamine. But the rewards are tiny compared to the cost of revolving debt and tiny compared to what that money could become invested. Tactic 2, They break the cost into painless slices. Monthly payments, minimum payments, pay in 4, auto renew. It's all the same psychological trick. Make the total cost feel abstract. Your brain is bad at abstract totals. Your brain is good at, can I afford it this month? So they sell you this month. Tactic 3, they remove friction and hide the leakage. Stored cards, one click, biometrics, instant approvals, subscription bundles. The goal is to reduce the time between impulse and purchase to near zero, because the shorter the gap, the less your rational brain participates. And if you think this is accidental, you're naive. Entire teams get paid to reduce that gap. Now, emotional reframe. You are not weak because you feel temptation. You are human. The question is, are you going to keep trying to win with willpower, or are you going to win with design? Japanese money habits, the ones worth copying, are design habits. They shift you from victim of convenience to informed player. So let's get to empowerment. Not vague inspiration. Real steps. Immediate move you can do today. Build a 2-account firewall with automatic one-way flow, not a budget, a firewall. Here's exactly what I mean. Open or designate 2 accounts. One is your operating account. This is where your bills and daily life happen. The other is your vault account. This is where your future lives. The rule is simple. Money flows from operating to vault automatically on payday, and it does not flow back unless you schedule it in advance. Not whenever you feel like it. Not if there's money left. Automatically. Now, you might be thinking, that's basic, Tom. Everybody says pay yourself first. Yes, but almost nobody implements it with a firewall and one-way friction. They implement it as an intention. Intentions die in the presence of one-click checkout. Here's the Japanese twist. The vault is not a savings account you stare at. The vault is an account you make slightly inconvenient to access. Remove it from your phone. No debit card attached. No instant transfer buttons. If you want to pull money from it, you add friction, waiting time, manual steps, maybe even a written note to yourself. That sounds dramatic. It's not. It's engineering. And if you want to make this even stronger, split the vault into 2 layers. A reserve layer for real emergencies. An investing layer for long-term compounding. Now you're asking yourself, okay, but how much goes into the vault? Here's a simple framework that ambitious men can actually follow. Pick a future rate. Not a savings rate, a future rate. Start with 10% of your take-home pay if you're in chaos. Move to 15% when you stabilize. Aim for 20% when you want serious momentum. And here's the key. Treat that future rate like a non-negotiable bill, because that's what it is. It's the bill you pay to become free. Now, second move, audit your silent interest rate. This is not basic advice. This is the one exercise that makes people angry because it works. List every recurring payment you have. Subscriptions, financing plans, memberships, buy now, pay later, car notes, anything that repeats. For each one, ask, what is the implied interest rate of this obligation on my life? Meaning, how much flexibility does it steal? And what would that same money become if it was invested monthly? If you have a $150 monthly leak, remember, that's roughly $180,000 over 30 years at around 7%. When you convert monthly leaks into future dollars, your brain finally feels the pain. That pain is useful. Japan's household discipline does this naturally because the culture respects waste as a real cost. You can manufacture that respect by translating leaks into lost futures. Third move, create an impulse delay rule that is automatic, not moral. Pick a number, 24 hours, 48 hours, 1 week, whatever fits your life. Any non-essential purchase above a threshold, like $100, must sit in a cooling list for that delay period. Not because you're punishing yourself, because you're letting your rational brain catch up. And here's the trick that makes it work. During the delay, you must choose what it replaces in your future rate. So if you want to buy a $500 gadget, You say out loud, "This is $500 that could have been invested." Now, you might still buy it. Fine. But you buy it consciously, not hypnotized. That's the shift from consumer to operator. Fourth move. If you carry revolving credit card debt, you treat it like an emergency, even if it feels normal. I'm not telling you to panic. I'm telling you to be honest. If your interest rate is north of 20%, that's financial gravity. So your plan is not invest and pay it down slowly. Your plan is stop the bleeding first. The Japanese habit here is not never use credit. It's never normalize toxic debt. And the actionable step is specific. Call the debt what it is, calculate the interest per month, and set a payoff timeline that is aggressive enough to actually change your life. Because paying it down slowly keeps you in the same identity, a guy who owes. Fifth move, protect raises and windfalls with a rule before they arrive. This is a big one. Most people get a raise and immediately upgrade life. New car, new apartment, better everything. And then they wonder why they still feel broke. So here's the rule. When your income goes up, at least half of the increase goes straight into your vault automatically for the first year. Half, not forever, 1 year. This one rule keeps your lifestyle from swallowing your progress. And it's exactly the kind of boring, structural decision that Japanese households are better at culturally, because stability is valued. Now, one more surprising revelation to land this. A lot of people think the Japanese habit is save more. No, the Japanese habit is make spending less automatic than saving. Americans made spending automatic and made saving optional. Flip that, and you will feel like your life finally has traction. And if you're the kind of guy watching this because you want $1 million without hype, without casino behavior, here's the truth. $1 million is not a number. It's a system outcome. If your system sends surplus into compounding every month, $1 million becomes a timeline question. If your system leaks surplus into convenience spending and debt interest, $1 million becomes a fantasy you talk about while you keep upgrading your phone. So copy Japan the right way. Copy the separation. Copy the friction. Copy the respect for cash flow. Copy the windfall rules. Copy the idea that stability is a form of power. But don't copy the mistakes some people make after trauma. Hoarding cash forever because it feels safe. Cash is stable, but it doesn't grow much. Safety without growth can quietly become another trap, because time passes whether you invest or not. The goal is not to feel safe. The goal is to be safe. And being safe means having reserves for life's punches and having invested compounding for life's freedom. Now, you might be thinking, okay, Tom, what do I do first? Like literally tonight. Do this tonight. Set up the vault and the automatic transfer on payday. Remove the vault from your phone, write your future rate on a note, and treat it like rent. Make a list of your recurring leaks and convert one of them into future dollars. Pick your impulse delay rule and commit to it like it's a law. Then, next payday, you'll feel something different. Your future will get paid without begging. And that's the whole point. Because the reason those old Japanese merchant ledgers were powerful wasn't the ink. It was the identity behind it. They weren't asking, can I afford this? They were asking, does this weaken my house? Ask that question about your life, and you will stop making expensive mistakes that everyone around you calls normal. If you want, in the next video, I'll show you how to structure the vault so it feeds a simple index strategy through your 401k and taxable accounts without getting trapped by fees and panic selling. And I'll show you the exact math of how small behavioral fees steal hundreds of thousands of dollars over a career. But for now, steal this from Japan. Stop trying to be disciplined inside a system designed to make you impulsive. Build a system that makes discipline the default. That's how you win.